Reverse mortgages, are they a great option to allow you to stay in your home, or are they just a way to incur more debt? We're going to discuss it with a first-time guest starting right now.
This is Debt Free in 30. Here's your host, Doug Hoyes.
We're here to talk about reverse mortgages, so let's start with the important stuff. Who are you and what do you do?
Right. My name is Alexandra Macqueen. I live here in Toronto. I'm a certified financial planner. I help people make decisions about their pensions, and I teach and write about finance.
And where do you teach?
At the Schulich School of Business at York University.
Ooh, okay, so we've got someone who actually knows stuff here. So this is going to be good. And CFP, we've had a number of them on the show here before. So I think all our viewers are familiar with what a CFP is. So that's good. That's an actual real thing. It's not like calling yourself a financial advisor or something, which is just a made up word. So that's good. Now your focus tends to be more on the retirement side of things.
Absolutely.
Is that correct?
Absolutely.
So, and we could probably talk for, 6 hours about all the different aspects of retirement. But today I want to narrow it down specifically to reverse mortgages because you've done some work and certainly some writing on that. So let's start with the most obvious question. What is a reverse mortgage?
Right. Well, think about what a mortgage is. So a mortgage is I go to the bank and I say, I want to buy this asset, a house. It's worth $1 million. I only have $200,000 saved. I need to borrow the rest, that $800,000. I'm going to pay it off slowly over time. The bank says, here you go. Here's the loan of $800,000. There's an interest rate on it. So you're going to pay an amount every month. That's a blended, it's some portion is interest and some portion is repayment of the loan principal. The reverse mortgage is actually the same thing in reverse. So I go to the bank and I don't have to borrow to buy the house. I own the house. Now I own this $1 million asset and I say, I want to create income from it. I want you to either give me a lump sum that's borrowed against the equity that I have in the house, or I want income every month that's going to take a little bit of that equity over time. And then it's repaid when I die.
So let's take a common scenario then.
Right.
So I am how old?
Well, you got to be 55 or older to qualify for these things, but apparently the average borrower is more like age 70.
Okay, so I'm 70 years old.
Mm-hmm.
Hey, look, not too bad for 70. I mean, not great, but not too bad. And let's say I have a house that's worth $1 million.
Right.
I mean, in Toronto, that would be a one-bedroom condo, but let's say that that's the case. So how much can I borrow?
You can borrow about 85%. So it depends on your age and some other things. I'm not an expert. I don't sell these things. It'll vary from product to product.
And that's actually a key point. Yeah. You're not a salesperson for reverse mortgages. There's lots of them out there. And that's one of the reasons I wanted to have you on, because you don't have a vested interest in whether I get a reverse mortgage or not. So, I mean, we're all biased. Obviously, you have your opinions on them, which we're going to talk about, but you're not trying to paint either a rosy picture or an unrosy picture about it, if unrosy is a word. I guess it is now. So, okay, so I'm 70 years old. I can borrow a certain percentage of the value of my home. And is that percentage higher or lower as I get older? So I guess if I'm 60 years old,
it's probably lower.
It would be lower. So maybe they'd only lend me 50%, 60%, 70%, or whatever.
And think about why. Because if it's repaid when you die, then they have to wait longer if you're younger.
Which means more of the equity could be soaked up. So I'm 70 years old. I've got $1 million house. I could borrow up to, let's call it $800,000.
Sure.
Just to pull a number out. And then how does it work then? So I go to the reverse mortgage company, they give me $800,000, and then how does it work with interest and with payments?
Well, so they can set up a reverse mortgage that's maybe up to $800,000. You're not required to take all that $800,000 at once. So let's say that you say, well, I need to, so scenario is mom and dad, they live in the house, they want to stay there. They have run out of their investment income. So they had RSPs, they had TF, whatever they had, they don't have it anymore. They have CPP and they have OAS, and it's not enough to keep them in the house. Maybe they want to do some renovations to the house, or maybe they have some debt that's built up that they want to repay. So a conventional scenario might be, we'll go to the reverse mortgage company, we're going to get a lump sum of $30,000 to repay some debt that we've got, and then we'll set up regular monthly income that's going to supplement our CPP, our OAS, our GAS if they have that, and for as long as we're alive.
So I could take a lump sum, or I could take $1,000 every month until
Sure.
I'm no longer here.
Now, you asked about the interest rates that I didn't comment on yet. So the interest rates are higher than they would be for a conventional mortgage and higher than they would be for a home equity line of credit. But here's the issue. Mom and dad don't qualify for either a HELOC or a regular mortgage. Why not? They don't have sufficient income.
Because they've got CPP and OAS and that's it, or a minor, not enough income. So long as you got equity in the house, you're going to qualify.
That's right.
Because that's what they're lending against. Now, you use the word income, which I would disagree with.
Cash flow.
Cash flow, okay. So, and it's not income because you're not earning it, but it's also not income because you're not paying tax on it.
Which is really important if you want to. So in our scenario where we have mom and dad with CPP and OAS, maybe they qualify for some low-income benefits, the guaranteed income supplement. That's a supplement to their OAS. The reverse mortgage allows them to preserve that. And keep in mind, that's lifelong income. It's inflation indexed. It will never go away.
So if I'm 70 years old right now, I make the deal that they're going to give me $1,000 every month. I guess if I live to be 150, maybe the math isn't going to work. But they figure, okay, well, you're probably not going to be here much more than 30 years, so the math all works. They figure out what they can do. They're not going to get up to their limit. So there are 0 repayments required. Is that the deal? 0
repayments required, but you can repay. Let's say that grandma is still alive. So there's mom and dad, and then there's grandma, and she's 90, and she passes away, and she leaves a small estate to mom and dad, and they say, well, we would like to repay a portion of the reverse mortgage that we took.
So let's talk now about the good and the bad.
Right.
Because there's 2 sides to every story, right? And I am not, personally particularly dogmatic on this. I think if someone on the street was to stop me, I'd say, oh, I don't like reverse mortgages. I think they're bad. Now, why do I think that? I don't know. It's not a particularly well-informed opinion, probably. Let's start with the good. So what are the reasons why a reverse mortgage is something you should consider?
I don't know whether I'd go so far to say that you should consider. So I would probably say in the right circumstances or given a set of circumstances, they may be the best available option. So I already mentioned if mom and dad have debt and they have expenses that they're not able to meet from their existing income or cash flow, and they have equity, it's, everyone says it's expensive. Yes, but at today's rates, we're at historic low interest rates. So reverse mortgage rates now are what the historic norm for mortgage rates has been.
Yeah, and we are, just to let everyone in on the inside here, we're recording this in December, just before Christmas, 2019. This is actually the first time we've recorded in our new Toronto studio here. So whether you can actually see this or not, I don't know if the technology is working or not. This will air in January. A reverse mortgage interest rate now is somewhere in the 5.5%, 6% range, something like that. And a conventional first mortgage, if you have perfect credit, full down payment, the whole bit, can be, it'd be under 4%, I guess.
Yes, but if mom and dad can't qualify, then there's almost no point in saying it's more expensive than a mortgage. So what you don't want is mom and dad saying, well, I'm going to borrow on credit cards, which are obviously much higher interest rates, or I'm going to get an unsecured line of credit that requires repayment and is also going to be a higher rate.
So I understand the concept here. I'm 70 years old. My wife and I are 70 years old, and we've got, this much coming in every month, $1,500, but we need $2,000 a month to survive. So we're getting an extra $500,000 a month from our reverse mortgage that allows us to stay in our home.
Right.
Why not just sell the home, cash in all that money, and go rent?
It's a very, that is the most common response. I'm certain that people are going to respond to this podcast with exactly that comment because I hear it all the time. But here's the issue. So this principal residence that we're borrowing against, the gains on it are tax-free. So let's take our 7-year-olds. If they don't have any other income or they've spent it all down, they don't have any investments that are giving them income now. So what you're saying is, okay, mom and dad, sell the house. Are they going to buy a condo? Are they renting? What are they doing with so we've sold it for $1 million. After they've repaid their debt, after costs, let's say they have $800,000 left over, they're going to spend $600,000 on a condo. Now they've got condo fees. Or they're going to rent. Now they've got rent that increases every year. If they're 70, they need to plan for as much as 30 more years of life. How much is rent going to increase by? The principal residence exemption means they can stay in that house as long as it appreciates at just the rate of inflation. Then they can actually take equity out today and still maintain that same equity over time to give to a kid, for example, and it's tax-free. I jammed a ton in that comment.
No, but that kind of hits the point. So if I was to rent a place in Toronto, let's say it's going to cost $2,000 a month.
Right.
You know,
Today.
Okay, let's say it's going to cost $3,000 a month. And that's not a palace. That's, one bedroom condo kind of a thing. So $3,000 a month would be times 12 would be $36,000 a year.
Mm-hmm.
Let's call it 40 so we can do the math in our head. Over 10 years is $400,000. Over 20 years is $800,000. And I only had $800,000 to begin with. So my runway is done in 20 years. Now, of course, that was a bit of a silly example because if you sold something for $800,000, I assume you could probably invest the money and maybe earn something.
Yes, but it requires mom and dad to do that. So are you comfortable, or are mom and dad comfortable saying, yes, we're going to set up a diversified portfolio that's going to generate 5%. By the way, all the income from that portfolio is taxable because they don't have any RSP room left and they're not generating any more.
You can't contribute when you're over a certain age anyways.
They have a little bit of TFSA room. You can't put that much in. So now they've got, whatever the number is, hundreds of thousands of dollars of taxable income. They've put it in bonds because they don't want to they can't really take any risk with it. They've also lost their GIS because they have this taxable income coming in from the portfolio. You can kind of see that it's more complex than is this good or bad. It really depends on where are mom and dad now, what's the income they need. If they really want to stay in the house, I think that's the defining factor. Do they want to move?
These would be good things to talk to a CFP about, probably.
They probably would be.
Throw a little commercial in there for if they want to sponsor the podcast, they know how to reach me. Okay, so on the good side, I can stay in my home.
Yeah.
There are no tax implications.
Mm-hmm.
I don't have to worry about selling my house, investing it, and timing is everything with investing. You happen to invest at the top of the market and we go into a prolonged down period, you can lose a chunk of your money. If you happen to invest at the bottom, well, maybe you can do really well. So, and again, I want to make it clear, if I may put words in your mouth, you are not recommending A or B.
Absolutely not.
We're just going through what the different thought process is. So on the positive side, stay in your house.
Yeah.
Now, I guess the negative side to staying in your house is, well, you're staying in your house. So you still got to pay for the upkeep and all the rest of it, but you're going to be paying hydro wherever you are, I guess. So, and there's no tax implications to it. You're already in the house. You're already set up. There's no transaction fees, whatever. You're already sitting there. Let's talk about, are those, that's the main positive then?
Well, I think there's two things, right? So the first is I said that they want to stay in the house. That's condition number one. Condition number two is you can maintain your standard of living. It's actually less risky. Because you're taking this asset, you're harvesting some of the equity in it that otherwise is doing nothing. Your house is a tax-free store of value that when it's paid off, pays a dividend called shelter. So you can maintain that shelter. Now you're going to have to spend money to maintain the house, whether you own it, whether there's a mortgage or not.
And if the real estate market crashes, it doesn't really matter.
These things aren't callable. Part of the reason that, and that means they cannot be recalled by the bank. So part of the reason reverse mortgages have a bad rap is people listen to how reverse mortgages in the U.S. work. So they're callable in the U.S. So you'll read news stories about retirees being forced out of a house they own and they've reverse mortgaged because the bank called the loan.
But that's not a thing here in Canada. You get to decide when you repay it or you're dead, and that's when it gets repaid.
And you don't have to repay it at the moment of death. I don't know all of the details for every issuer, but as long as one of those two spouses is living in the property, there's no repayment requirement. And even after the second spouse passes on, there's a number of months that before they'll start to ask for repayment.
It's not 10 minutes later that it has to be repaid. Okay, so we've talked about the good.
Yeah.
Now, like you say, they have a bad rap.
Mm-hmm.
Perhaps some of that is because of U.S. experience, but I did some show prep here, and I have things where here's reasons why reverse mortgages are a problem. So I'd like you to comment, agree or disagree. So number one, the interest is still compounding.
Absolutely it is.
Okay, so that's pretty obvious then. So I borrow 500,000. 20 years from now when I die, I will owe more than 500,000. That's how it works.
Yes, but think of it this way. If the house continues to appreciate, then your equity is still growing. You can actually take out some amount today and not be any further behind.
Yeah, depending on what the real estate market does, obviously. So if you're paying $30,000 in interest a year, you're not paying it. But if it's accumulating and the house is going up by $30,000 a year, well, then I guess you're even. Now, if the house is going down by $30,000 a year, well, obviously you're eating into equity.
Yes, but it's risk free because so you can borrow up to 85%. If the value of the housing market crashes, we see 1989?
Yes, it was.
Toronto market crashed. So we have that same event again. It's still not callable. Nothing changes. So it's the lender who's taken the risk.
This is where we put the plug in for my book. So around about page 117, I tell the story, Straight Talk on Your Money is the book, where I tell the story about 1989, which of course was the year I bought a house. Nailed it, man, right at the top. So you can read about that there. We already mentioned that the interest is higher than what it would be on a HELOC or a traditional mortgage, but you probably don't qualify for a HELOC or a traditional mortgage, or maybe you do, but in most cases, well, the whole reason I'm doing this is because this is the most logical option. So yes, it's true, but it may not be relevant in this part. I mean, if I've got $1 million of equity in my house, and I think over the next few years I'm going to need 100,000, would a HELOC make more sense? I guess only if I can borrow 200,000.
You're going to, all things considered, you're going to have to borrow more from the HELOC because it requires repayment. So now you're increasing the amount of debt because you're meeting the ongoing debt obligation.
So it may or may not be a good idea.
Well, this is where you get the sharp pencils out,
the numbers out. You got to crunch the numbers. Okay, reason why they're bad, number 2, a lot of extra costs. When you set up a reverse mortgage, I mean, when you set up any mortgage, there is a home appraisal fee. There's probably a setup fee. There may be a prepayment penalty if you prepay it before a certain period of time. There may be other fees. Is that a consideration, or?
Well, I think it's really important to know exactly what the costs are. But again, but is your comment about the costs are hidden or the costs are too expensive?
I guess a bit of both, and you're right. The answer in both cases is crunch the numbers.
Right.
So now, are reverse mortgages available? It used to be in the old days that there was, 1 or 2 companies, and they ran infomercials at midnight talking about these things. Is it more mainstream now? Can I go to a bank, or is it still?
There's no banks that are doing it. It's still just, and I actually have no idea whether this market is going to grow. But we were talking about this earlier. We're in this really unprecedented moment, right? So when I was growing up, and probably when you were growing up, the story was get a house early in your 20s. Kids are coming. You can't really stop them. So you're going to have these kids in your 20s. You're going to repay the mortgage by the time you're 50. Remember mortgage burning parties? And then you have 15 years to save for retirement. None of that works anymore. But nobody thought about their houses as the investments. They think about them now. So I bought a modest East Toronto house in the year 2000 for a tiny fraction of what it's worth today. And through really no effort on my part, this thing has increased in value dramatically. And we don't know, I think, as a society, how to cope with these kind of lottery win experiences. People are arriving at retirement with $1 million or more of housing equity.
Yeah, which is a real number if they're selling the house. If they're continuing to live in it, then they might be asset rich and cash flow poor.
Well, and that's kind of, this kind of gets into the whole sales vibe. But if you've got $1 million of equity in a house, and it's not doing anything for you other than providing shelter, and you need money. This is the rationale for the reverse mortgage.
Yeah, and the stockbrokers or the portfolio managers would say, well, wait a minute, sell the house, you got $1 million, and you can invest that and earn 5, 6, 7% a year.
Well, you maybe, but the thing is you're exposed to all kinds of risk so there's no scenario that's free of risk. But in that scenario where, mom and dad are just going to invest with a stockbroker, you want to talk about costs to set up the reverse mortgage. There's costs to working with a broker or any kind of investment.
Well, what if I just buy, one ETF, low-cost ETF?
You can reduce those costs. But what's the low-cost ETF that's free of risk, that's going to guarantee you that money. If you want any kind of guarantee, it costs money. So I want surety of income. I'm going to pay.
Yeah, and so I guess that would be a Government of Canada bond or T-bill or something, but then the interest rates are not 5 or 6%. They're closer to zero, 0.5%, 1%, 2%, something like that. So
all of which is taxable.
Yeah.
Right?
So
Because I've got it in this tax. Think about the house as a giant TFSA.
Which, and your analogy being you don't pay tax on what the increase in a TFSA is.
Well, you've got it there. You kind of landed at retirement in our fictional scenario. You've ended up at age 55 or older with all this equity that kind of just appeared out of nowhere. You didn't have to invest. You didn't have to make decisions. You didn't have to make any payments or incur any costs. This is just, it's like a TFSA that somebody just automatically filled for you over time.
So if I was coming up with a checklist, and I'll get back to the bad things, but my mind sort of wanders here. I go off on a tangent. So who should consider getting a TFSA? Number one, I want to stay in the home. I mean, if I want to
reverse mortgage.
A reverse mortgage. If I want to move to a condo, well then okay, we're not having this discussion obviously. Right. But I really want to stay in the home I'm in. So that would be number one. If you're not there, then we're not even having this discussion. Then secondly, I guess there would obviously have to be some equity in the home. I mean, if I'm already mortgaged to the hilt, then this is not a consideration to have. And probably if you're mortgaged to the hilt, well, maybe selling the home and renting maybe does make more sense because you're much more susceptible to real estate fluctuations, whatever. What would be the third thing that would be on my checklist then?
I have either a lump sum income requirement or an ongoing income requirement, or maybe both. So I want to renovate the house to be able to stay in it longer.
So a cash flow requirement.
Right. I want to pay for nursing care. My spouse is getting older and they require some hands-on care maybe every day, and I just can't afford it on my current cash flow. Okay, I could access some money from this. Now, I can give you a whole laundry list of reasons where I don't want this to pay for somebody's destination wedding. If it's not so that you can go out and buy a luxury vehicle.
What about Bitcoin? Okay, so you don't think that's a good idea there. Okay. So, but I get what you're saying. Yeah. This is, and those are pretty good criteria, right? There is a specific need for the money. Yeah. I need an ongoing cash flow. And you're right. My spouse requires nursing care.
That's right.
We can stay in the home. Mm-hmm. I need a couple of $1,000s a month to cover some of the cost of that. Perfect way to do it. I can get a bit of a lump sum to do a retrofit, put in a wheelchair ramp, put in a special bathroom, whatever. I can stay in the home. We're not moving into some kind of assisted living facility. That would probably make perfect sense. Okay, but I am now stuck in the home, am I not?
Well, if you sell the home, then the reverse mortgage needs to be repaid. But it's in that way, it's not any different from a conventional mortgage.
And so if at the time I decide I'm moving into a retirement residence or I'm dead or something, and the real estate market has crashed, so I borrowed $800,000 or I owe $800,000 and the house is only worth $700 now.
You don't owe any more than what you borrowed.
I'm not liable.
No.
Okay, so it's a non-recourse thing, which is not something we have in a conventional mortgage, but it's definitely something we have in a reverse mortgage. So when I die, I think you already answered the question. It gets paid out within a certain period of time. Right. It doesn't have to be the next day. But if there are two spouses at the start, if one of them dies, the other one can continue on.
That's correct. Now they have to live in the house. So if spouse number 2 ultimately goes to an assisted living facility, there is going to be a requirement to repay at a certain point. And that, again, will differ from product to product.
And this is not something for real estate speculators then. You cannot get a reverse mortgage on your rental property.
That's correct.
You have to be living in it. Okay, so
it's for your principal residence.
Principal residence.
Yeah.
So that's a key point. Wouldn't apply for the cottage or anything else as well. Okay, now, more show prep. I got more show prep here. I actually did more research. Our average client, so I'm talking about here at Hoyes Michaelis, our average senior client is 67 years old, because we define seniors as anything over 60. We just made up that definition. Is 67 years old and owes on average about $63,000 in unsecured debt, which is actually higher than our 50-year-old clients or 40-year-old clients. 53% of them are retired. Okay, that kind of makes sense because if they're average of 67 years old. Only 6% are homeowners because most of my clients at the moment are not homeowners. The house equity's gone up. They've been able to use that to service their unsecured debts. But obviously, debt is a problem for seniors, and particularly seniors who haven't owned a home. Now, you wrote an article for moneysense.ca. I believe it came out in November, and I'll put a link to it in the show notes on our YouTube channel. Here's a quote from the article. Home Equity Bank says their average customer is a 72-year-old, which is basically what you just said a few minutes ago, who borrows $170,000 to pay down their debt and supplement their income. So are you concerned about debt levels in seniors? And I understand that a reverse mortgage may be a good option for someone who's got $50,000 owing on their credit cards, but they got $1 million worth of equity. This is a good way to pay it off. But are you concerned, as I am, about debt levels for seniors?
It's a great question. And I think there's a couple of different ways to look at reverse mortgages. And so far we've been talking about this micro level view with this stylized example of mom and dad who are whatever age. But if we just look at, I had Scott, your colleague, in to speak to my MBA students a year ago, so last January 2019, and we were talking about rising debt levels by age cohort, and I was using the Stats Canada data and pointing at it's seniors. In fact, there's a statistic about seniors with having more student loan debt. I don't even know what that is. Maybe they're co-signing on student loans. So at the macro level, increasing levels of debt it's a real thing. I think that what you ultimately have with the reverse mortgage is that you have one set of Canadians who own homes in hotter markets that get this kind of potentially get out of jail card free that if you're not a homeowner, you just don't have.
Yeah, and that's exactly what we see with our client base, that if you bought a home 20 years ago, you're not one of my clients.
So it used to be, so again, I think a lot of Canadian personal finance thinking is very influenced by what people see and hear from the United States. And in the U.S., the mortgage market is quite different than it is here. So you get these 30-year mortgages, right? So we have super low rates. You can get that rate for 30 years. So people really think about getting into a house, something you need to do early in life because it's this inflation hedge against the rising cost of shelter. I'm going to get in that house. I'm going to pay it off. I have somewhere to live forever. Now, that's still true in Canada, but where am I going with this? The impetus to get into a house is so strong right now because people see the increase in equity. It's all I hear about from people who are younger than I am and who aren't homeowners.
Yeah, and you already used the term unprecedented moment. It is essentially impossible if you're 25 years old and just starting your career to be buying a home. Because you probably got $50,000 worth of student loan debt. It's going to take you 10 years because in Canada, on average, it's about 9.5 years to pay off student loan debt. And you got to get out of debt before you can start saving for a down payment, before you can buy. So you're probably going to be 35 or 40 years old before you're buying a home. And so that curve that you just talked about, it's 20 years later than it was back in 1950.
And we're seeing it when we see seniors, people entering the traditional retirement age with more debt. So I talked earlier about what we call life cycle economics, right? So the idea that your 20s are for this goal and your 30s are for this goal and blah, blah, blah. And I said it's all broken down. So we are getting homes later. You just said that. We're having kids later compared to my parents, for example. But I think our personal finance thinking hasn't really evolved to figure out, well, how do we respond now, given the conditions we have now? So what you see is people with significant amounts of debt later in life.
Yeah, and we're absolutely seeing that.
Well, and so I think you can also go down the road of is it good or bad? So given that rates are so low, it's certainly less bad than it would have been 20 years ago. But is it good? I mean, this is why we see reverse mortgages. This is why MoneySense asked me to write this piece, because the data on reverse mortgages is that they're absolutely booming.
Mm-hmm. Yeah, and again, I'm not taking any position one way or the other on it. I think you got to crunch the numbers and see. You're right. We're in a low interest rate environment. If you believe the numbers, we're in a low inflation environment, but it has certainly picked up during 2019 and into 2020. So if inflation is going up and interest rates are still contained, well, then having debt is actually not a bad thing because you're paying back in depreciated dollars. Now, I'm certainly not advocating that because there's a whole bunch of other major negatives to that. Now, final question then. What about alternatives then? So I'm 70 years old. I'm trying to decide, should I get a reverse mortgage because I need to supplement my cash flow each month? What are other options I could be considering?
Well, the question is, that is the question. So if my hypothetical or our hypothetical couple comes to me and says, I need to figure out how to supplement. So one option is, well, you can lower your standard of living. You can just spend less. Most people, most of the time, that's not a very palatable answer. I mean,
well, and if part of the money I need is for nursing care for my spouse, or I like to eat food, then that may be difficult. But yes, I totally agree. Step one, maybe you don't need to eat out 5 nights a week. Maybe you don't need to subscribe to 14 different newspapers, whatever it is. So, cutting your expenses. So I agree. That would
so you could do that. And then you start to look at, well, what are the available options? If this couple has no other investments, but let me go another way with this, because so I said that you can look at reverse mortgages from an individual point of view or from a macro point of view, like where is society going with debt? Another way to think about them is from a portfolio management point of view, which is kind of like the finance nerds, right, conversation about how do these things fit into a portfolio. But let's say there's lots of different ways that you can think about housing equity on the personal balance sheet. So I know that I can get more CPP and more OAS if I defer it. I can actually get significantly more if I defer it. So if I don't take my CPP at 60, I don't take my OAS at 70, I defer both at age 65, I defer both to age 70 and get way more. Maybe I take a reverse mortgage just to cover the cash flow need in between age whatever I am now and age 70.
I like that. The portfolio approach, this is one tool in the tool chest. And you're talking a few $100 extra a month, I assume, by deferring CPP OAS for 5 or 10 years. So what it comes down to then is this is not a trivial decision. This is a real life decision. And there are a lot of nuances to it. So it probably wouldn't be a bad idea to actually sit down with someone who has some expertise in this area and help them crunch the numbers with you. And the reason I'm a big fan of CFPs, Certified Financial Planners, and in particular, fee-only financial planners, is they don't have a vested interest in whether you buy a house or don't buy a house, take a reverse mortgage or don't, buy a stock, a mutual fund, an ETF, Bitcoin, which apparently is what I'm advocating today, which is why people don't take investment advice from me because I don't know what I'm talking about. It's a much more holistic approach.
That's right.
Let's see what works for you. So, and I know when people come to me in this situation and they say, well, I got a bunch of debt, but I do have a house, I look at it and go, well, is there enough equity in the house to deal with the debt? If there is, that's probably the answer. But we're seeing more and more people now who are filing a consumer proposal to deal with their debt because it's difficult in some cases to unlock the equity in the house. Now, it may mean we end up filing a consumer proposal for 100 cents on the dollar, and all they're getting is a break on the future interest. But from a cash flow point of view, because we can stretch it over 5 years, that may actually work out better for them too. So it's a different option, again, that we're seeing more and more of.
Well, this is exclusively a retirement income discussion, right? Or a retirement discussion. Because if you can't access that until you're 55. So if you have a lot of debt and you're 45, the reverse mortgage is not a way
thing.
No.
Yeah.
So and I have to say that example I gave about deferring CPP is fairly esoteric. Like that's kind of like a little narrow. But if you start to think about this thing as a tool in the toolbox, as you said, then you can start to think, so I have this asset on my personal balance sheet. Do I use it? And if so, how and when?
Which is kind of what I would do if I had cash in the bank or an extra car in the driveway. I mean, it's an asset. Can I sell it? Can I liquidate it? Can I borrow against it?
But people don't think about, in Canada, we really don't think about the principal residence in that way. That's why I said think about it like a giant TFSA as another way to think about it. We think, no, the principal residence is exclusively to provide shelter and then to give to the kids.
Mm-hmm. Yeah, and I'm not a big fan of the give to the kids thing, personally. I have 2 kids, and I've explained to both of them that when, my wife and I die, we're leaving it all to some charity, whether we like the charity or not, get out there and work. But that is a very common thought process that I definitely have to preserve the house for the kids.
Well, and then are mom and dad going to live in this diminished living standards, with not having the care that somebody requires, or just not having whatever would make their life a little better in the last decade of life, right? Are they not going to have that in order to try and preserve equity for the millennial kid who's saying, but I'll never get into the housing market unless mom and dad leave me their house?
Mm-hmm. And I don't know. I think parents, once your kids are growing, I think parents should be taking care of themselves. But I guess that's just my perspective.
My kids are convinced that I'm going to leave the house and they will live there.
Yeah. And I think my kids are probably convinced they'll never own a house because it's just not feasible, but that's okay too. I'll live in a smaller place, keep my costs down, and it's all good. So it's a totally different perspective. Well, that's a fascinating conversation. It's been longer than Debt Free in 30 today, but it's, I think been well worth it. How can people track you down? What's, Twitter? Right. Where's the place to find you?
Twitter is @moneygal.
That is a cool handle. Short, easy, MONEYGAL.
Yeah.
And is that the best place to?
That is the best place to find me.
There you go. Alexandra Macqueen @moneygal on Twitter. And on your Twitter profile, I think you got links to websites and other things like that. You can do a search for your name. I'll put a link to the Money Sense article on our YouTube channel in the comments section. Thanks very much for being here. I appreciate it. That was our chat on reverse mortgages. And again, the full audio is available on every podcast app and then on YouTube for the video. So that's our show for today. Thanks for listening. Until next week, I'm Doug Hoyes. That was Debt Free in 30.